India was the third largest economy just 2 months ago. Today it's the sixth, because we might earn in rupees, but globally will be valued in dollars. Suddenly this 9% depreciation is just torn us apart. And going back to third is now looking such a tall order.
What happens when a country reports strong economic growth, but its currency hits a record low, and foreign investors remove lakhs of crores from its stock market? In 2026, the Indian rupee weakened sharply against the dollar as oil shocks, global conflict, high American yields, tariffs, and investor fear placed pressure on the economy. At the same time, official data still showed India growing faster than most major economies. Both statements can be true. National GDP can rise while workers lose jobs. Real wages remain weak, debt grows, and imported essentials become more expensive. Why the rupee fell and why it matters. The rupee reached a record low near 96.96 to $1 in May 2026 and remained above 96 in July. It had weakened by roughly 6% during the year and about 10% over 12 months. Calling this a collapse is dramatic, but the decline is large enough to affect businesses and households. A currency weakens when demand for foreign money exceeds available supply. India needs dollars to pay for crude oil, gas, fertilizer, machinery, electronics, defense equipment, and other imports. When oil prices rise, or investors move money to safer and higher-yielding markets, demand for dollars increases. The Reserve Bank of India can sell reserves, change liquidity, or use other tools to reduce sudden movements, but it cannot permanently ignore global forces. A weaker rupee makes foreign travel and education more expensive, but the bigger effect comes through imported energy and materials. India imports most of the crude oil it uses. Higher oil costs spread into transport, farming, manufacturing, electricity, and food. Exporters may receive more rupees for each dollar earned, yet that benefit can disappear when imported inputs, tariffs, or weak overseas demand raise their costs. Strong GDP can exist beside household stress. Official data showed India maintaining growth around 7% in the 2025-26 financial year, making it one of the fastest-growing major economies. That is not a fake number simply because many people feel pressure. GDP measures total production and spending. It does not show how evenly income is shared, whether new jobs are secure, or whether wages beat inflation. The source uses Surat diamond worker Alpesh as an example of the human cost. The diamond industry has faced weaker global demand, sanctions on Russian stones, changing consumer preferences, and trade pressure. Workers have reported layoffs, lower wages, reduced hours, migration back to villages, and severe personal distress. Similar risks affect garments, shrimp exports, information technology, and other industries exposed to foreign demand or automation. Household borrowing has also risen. Debt can help families buy homes, vehicles, education, or business equipment. But personal loans and credit card balances become dangerous when income is unstable. Consumption may look strong for a time because people use credit, even as their emergency savings shrink. That is why fast GDP growth can exist beside anxiety about jobs, school fees, food, fuel, and monthly loan payments. Foreign selling, reserves, and external shocks. Foreign portfolio investors sold about 2.7 lakh crore rupees of Indian equities during the first half of 2026, more than the total withdrawn in 2025. The selling reflected global risk aversion, higher U.S. yields, concerns about Indian valuations and earnings, rupee weakness, and capital moving toward American technology and other opportunities. It does not mean every foreign company abandoned India. Gross foreign direct investment remained much larger than net FDI because foreign companies also repatriated profits and Indian firms invested abroad. The difference matters. Portfolio money can leave quickly, while factories and long-term businesses move more slowly. Treating every outflow as proof that investors have lost all faith is inaccurate, but sustained selling can weaken markets and the currency. India's foreign exchange reserves fell as the RBI defended the rupee, but they remained among the world's largest. Reserves are not a simple emergency bank account because their value includes foreign assets, gold, and other components. The fall deserves attention, yet India was not close to running out of dollars. The real risk is a long period of expensive oil, weak exports, capital outflows, and repeated intervention that steadily reduces the cushion. Debt, inflation, and the difference between crisis and collapse. The IMF estimated India's general government debt at about 83% of GDP in 2026. That is high and limits how freely the government can respond to new shocks. But most public debt is denominated in rupees and held within the domestic financial system. This makes India different from countries that collapse because they cannot repay large foreign currency debts. Official consumer inflation can remain moderate even while certain essentials rise sharply. A national index averages many products and households. Poor families spend a larger share on food, fuel, rent, and transport, so their personal inflation can feel much worse. Wholesale increases may also reach shops later. The official number is not automatically false, but it cannot describe every family's experience. India faces real danger if currency weakness combines with expensive energy, unemployment, weak wages, stressed household debt, lower exports, and limited government finances. It also has defenses, a large domestic market, strong services, substantial reserves, a regulated banking system, local savings, and continued growth. The correct response is not panic. It is transparent data, job creation, export competitiveness, energy security, careful debt management, targeted help for vulnerable workers, and policies that raise household income rather than only headline GDP. India's economy is under serious pressure, but pressure is not the same as collapse. The rupee's record low raises import costs, foreign selling weakens confidence, and expensive energy can spread inflation through every household. The biggest danger is not one round number such as 100 rupees to the dollar. It is a long period in which wages, jobs, exports, and family savings fail to keep up with prices and debt. India will be safer when policy focuses on productive employment, competitive industries, reliable statistics, lower energy risk, and direct protection for workers whose lives are hidden behind national averages. If you enjoyed this deep dive into their life and career, don't forget to like the video, subscribe to the channel, and turn on notifications so you don't miss our next story.